Hey everyone, and welcome back to the Deep Dive. Today we're diving into something that I think a lot of you are going to find really interesting. We're going to be looking at ultra-high yield dividend stocks for 2025. To do this, we'll be breaking down a recent article by Keith Spates from the Motley Fool. It was published really recently, actually, just on December 30th, 2024. So it's got some really fresh picks in here for 2025. What's really interesting is that he's got 5 companies that he thinks could do really well. So we're going to be talking about what makes each of these companies so special and why Spates is so bullish on them. And, of course, what risks you might want to consider. Now, some of the stuff that jumped out at me when I was first reading the article was there's this prediction about drill, baby, drill.
Yeah.
You know how that's always coming back.
Yeah.
And how that could impact the energy sector. And then there's a potential mega merger that we're going to be talking about that could really shake things up in the auto world.
Yeah.
And then there's even a company that's been increasing its dividend every single year for 30 years. It's got to be worth a closer look, right?
It definitely is. But before we jump into all those really specific companies, I think it's good for us to take a step back and make sure we're all on the same page here.
Yeah, good idea.
What exactly are ultra-high yield dividend stocks, and why are people making such a big deal about them?
Well, imagine you're a business owner and your company's doing really well. You're making a profit. So now you could reinvest all that money back into the business. But you decide, you know what? I want to share some of that profit with my investors. That's a dividend.
Okay, so like you're giving your shareholders a slice of the pie.
Exactly.
Okay.
And when we talk about ultra-high yield, that means those slices are extra generous, significantly bigger than your average dividend payout.
Okay.
So we're talking yields of 6%, 7%, maybe even 8% or more.
Wow, yeah. That's definitely way more than your typical savings account would give you.
Right. It really catches your attention.
Yeah, it does. But I also know that higher reward usually means there's higher risk too. So what's the trade-off here?
You're thinking like a true investor. It's a great question.
Yeah.
Because you're right. If something sounds too good to be true, well, it probably is. If a company's paying out such a huge amount of its profits, it might mean that they're actually facing some challenges.
Okay, yeah, I see what you're saying.
Maybe they're struggling to invest in growth. Or they're having a hard time navigating their industry. So we really need to look beyond just the yield and actually understand the company's overall health and their strategy.
All right, so let's start digging into Spates' picks then. First up is Ares Capital, and they have a really tempting 8.72% forward dividend yield.
Yeah, that was interesting. Ares Capital is what's known as a business development company, or a BDC for short.
Okay, BDC. I don't think I've heard of that before.
So have you ever thought about investing in private companies?
I mean, not really.
Well, BDCs give you a way to do that indirectly.
Oh, really? How does that work?
So they basically invest in private, mid-sized companies. A lot of times providing loans or other kinds of financing. It's kind of like being a specialized lender. But instead of giving loans to individuals, they're targeting businesses that have a lot of potential for growth.
So they're kind of like venture capitalists, but with loans instead of equity?
You got it. That's a great analogy. There are definitely some similarities there. But the key difference is that BDCs mainly lend money, whereas venture capitalists usually take ownership in the companies they invest in.
Okay, that makes sense.
Now, what makes Ares Capital so interesting is that it's actually the biggest publicly traded BDC out there.
So it's the biggest one?
Yeah, it is. So that gives them a really strong position in the market. And this market is seeing some major tailwinds right now.
Oh, really? What kind of tailwinds?
Well, for one thing, more and more mid-sized companies are looking for funding. And there's also a growing shift towards private capital. That's money that's not coming from traditional banks.
So like from other sources.
Exactly. And this creates a great opportunity for companies like Ares Capital.
Gotcha.
Plus, Spates points out that they're trading at a pretty attractive valuation right now.
Yeah, I saw that.
Yeah, it's currently trading at just 10 times forward earnings, which suggests it might actually be undervalued by the market.
Interesting.
But of course, we still need to do our due diligence. Look at how they manage the risk in their lending portfolio. And, think about things like how rising interest rates could impact their business.
Yeah, good points. Okay, so next on our list, we have 2 energy giants, Enbridge and Enterprise Products Partners. I'm sure some of you have heard of these companies before, especially if you're interested in the energy sector.
Yeah, these guys are big players. Think of these companies as the arteries of the energy industry. They operate in what we call the midstream sector, which basically means they're the link between those who produce oil and gas. and those who consume it.
So they're not out there drilling for oil themselves, but they're the ones who make sure that the oil and gas actually gets to where it needs to go. You got it. They own and operate this huge network of pipelines and storage facilities and processing plants. And this makes their business model really pretty stable, even when oil and gas prices are all over the place.
And that stability is a big reason why their dividend yields are so good, right? Enbridge is at 6.44%, and Enterprise Products Partners is even higher at 6.76%.
Yeah, those are impressive yields. But what's even more impressive is their track record of actually increasing their dividends.
How so?
Well, Enbridge has raised their dividend consistently for 30 years.
Whoa, 30 years in a row.
30 years straight.
That's incredible.
What's their secret? Well, it's a few things, actually. First off, they operate in a sector that's essential to the global economy. I mean, yeah, it's facing some long-term challenges, but it's still essential. Second, they've been really disciplined about managing their finances. And they've been smart about investing in projects that generate reliable cash flow. And that allows them to reward their shareholders year after year, even when things get tough.
So they're not just riding the oil and gas wave, they're actually making strategic moves to stay ahead.
Absolutely. Like Enbridge has actually been diversifying their business by expanding into natural gas utilities. They're actually the biggest natural gas utility in North America right now. And they serve markets with growing populations and where the demand's increasing.
Smart.
And remember that drill baby drill thing we talked about earlier?
Yeah.
If the incoming Trump administration actually pushes for more domestic oil and gas production, that could be a real boost for companies like Enbridge and Enterprise Products Partners.
Right, because more production means more demand for their pipelines and infrastructure.
Exactly.
Of course, it's not a guaranteed win. Global energy demand and all the geopolitics stuff plays a big role, too.
Oh, absolutely. Those are always wild cards. Now, let's switch gears for a second and talk about a potential comeback story. Honda Motor.
Okay, yeah, Honda. They seem like a bit of a wild card to me. I know they had a bit of a rough year in 2024, but Spates seems to think they still have some potential.
Yeah, he does. So even though they had some setbacks, they're still offering a really tempting 4.94% dividend yield. And they're trading at a pretty attractive valuation too, just 6.75 times forward earnings. But what's really exciting here is that they might merge with Nissan.
Whoa, a Honda-Nissan merger. That would be a huge deal.
It would be massive. We'd be talking about the world's third largest automaker.
Wow. What would something like that even mean for the auto industry?
Well, for starters, it could totally shake up the whole landscape, especially in the EV market, which is, growing like crazy. Nissan is actually ahead of the curve in EVs. So if they combine their expertise with Honda's resources, that could be a really powerful combination.
Yeah, I could definitely see that being attractive to investors, especially the ones who want to get into the EV boom.
Yeah.
But I mean, merging two huge companies like that can't be easy, right? What kind of challenges do you think they might run into?
Yeah, you're right. It's not just about combining finances. You got to integrate different company cultures and streamline all their operations. Plus, there's always a bunch of regulatory hurdles to jump through.
Yeah, I can imagine.
It'll be really interesting to see how they handle all of that.
Definitely a lot to watch for in 2025. Okay, so the final company on our list of contenders here is a name I'm sure everyone's heard of. Pfizer. They're a giant in the pharmaceutical world. But I know they've had some struggles lately.
Yeah, they've been facing some headwinds. Sales of their COVID-19 products have been declining.
Yeah.
And then there's that dreaded patent cliff, where the patents on some of their biggest drugs are expiring.
Oh, yeah, that's right. So how are they even planning to keep those dividends flowing with all those challenges coming up?
Well, they're basically doubling down on research and development. They're putting a ton of resources into their pipeline of new drugs and therapies, especially in areas like oncology, immunology, and rare diseases. They're also looking at strategic acquisitions to beef up their portfolio.
So they're innovating and diversifying to stay ahead.
Exactly. They're not just sitting around. And here's another interesting thing. Even with all these recent challenges, Pfizer's trading at a surprisingly low valuation right now.
Right.
Yeah, it could be a sign that the market's underestimating their long-term growth potential.
That is interesting.
But of course, we still need to do our homework. Look at their financials. Check out their pipeline.
Yep.
And really get a feel for their overall strategy.
Makes sense. So, okay, we've met our 5 ultra-high-yield contenders. Each one has an awesome dividend yield, but they're all facing their own unique challenges, too.
Yeah, for sure.
What are your initial thoughts? Are any of these companies really jumping out at you?
I'm really intrigued by that potential Honda-Nissan merger, especially with everything going on in the EV market. But I'm also really interested in seeing how Pfizer handles that patent cliff. Whether they can really succeed there will determine their long-term sustainability.
Yeah, I'm with you on the Honda-Nissan merger. I think it could totally disrupt the market, but it's also really risky. And yeah, with Pfizer, I'm a bit wary of those patent expirations, but I'm definitely curious to see how their pipeline develops. But hey, before we get ahead of ourselves, I think it would be good to talk about how we can actually evaluate these ultra-high-yield dividend stocks properly.
Yeah, let's do it.
Like, what are some key things we should be looking at before we even think about investing?
That's a great question, and that's exactly what we're going to be diving into in our next segment.
Awesome.
We'll explore some crucial metrics and red flags to watch out for so you can make informed investment decisions.
All right, everyone, stay tuned. We'll be right back after a quick break.
All right, everyone, welcome back to the Deep Dive. We've just met 5 companies with some serious dividend potential. Ares Capital, Enbridge, Enterprise Products Partners, Honda Motor, and Pfizer. But before we get carried away by those juicy yields, we need to make sure we're evaluating these opportunities the right way, like seasoned investors. Exactly. It's like we found the treasure map, but now we need to learn how to read it. You know, that high yield, it's like a sparkling gem. But we need to make sure it's not fool's gold.
Right. So what are the essential tools for our treasure hunting kit here? What are the key metrics or red flags we should be looking for when we're evaluating these ultra-high yield dividend stocks?
Well, let's start with the payout ratio. This basically tells us what percentage of a company's earnings is being paid out as dividends. Imagine the company's earnings as a pie. The payout ratio shows how much of that pie is being sliced up and given to shareholders.
Okay, that makes sense.
No, a high payout ratio, let's say
Yeah.
over 80% or 90%. Could be a warning sign.
Really?
Yeah.
Why is that? I mean, wouldn't a company want to share most of its profits with its investors?
Well, it could mean that the company's stretching itself too thin. Like someone who's living paycheck to paycheck,
Oh, okay, I get it.
they might not have enough money left over to reinvest in growth, or to pay down debt, or even just to handle unexpected economic problems. So if their earnings take a hit, that high payout ratio could become unsustainable, and they might be forced to cut the dividend.
And that's definitely something we want to avoid as investors.
Absolutely.
What else should we be looking at?
Well, debt levels are super important too. High debt can be a real burden for any company, especially when interest rates are going up. It's like carrying around a heavy backpack full of rocks. Makes it way harder to climb uphill.
Makes sense.
So we want to look for companies with manageable debt levels and a solid track record of generating enough cash to cover their obligations.
Okay, so it's not just about how much they're paying out, but also how much they owe. What about cash flow? That's got to be important too, right?
Oh, absolutely. Cash flow is crucial. It's like the lifeblood of any dividend-paying company. It's what fuels those dividend payments. We want to see companies with consistent and growing free cash flow. That means they're making more than enough cash to cover their operating expenses and investments, leaving plenty of room for those dividends.
Okay, so we've got the payout ratio, debt level, and cash flow. Anything else we should be adding to our checklist?
Those are the core financials. But you also need to zoom out and look at the bigger picture. Think about the company's competitive landscape. What industry are they in? Is it growing? Do they have something unique that sets them apart from their competition? Are they adapting to new technologies? Are they keeping up with changes in consumer behavior?
So it's not just about crunching the numbers, it's about understanding the story behind the company.
Exactly. We're not just looking for companies that can pay their current dividends. We want the ones that can actually grow those dividends over time.
Right, we want to ride that wave of success.
Precisely.
Okay, so let's say we've done our due diligence. We found some promising ultra-high yield dividend stocks that check all the boxes. How do we actually go about building a portfolio? Are there any strategies we should keep in mind?
Well, diversification is always key, especially when we're talking about investments that have a higher risk. Think of it like a balanced meal. You wouldn't want to eat just one type of food all the time, right? You need a variety of nutrients to stay healthy.
Right, don't put all your eggs in one basket.
Exactly. Spread your investments across different sectors, different industries, and maybe even different parts of the world. That way, if one company or one sector has a rough patch, it won't completely derail your whole portfolio.
Makes sense.
And within the world of ultra-high-yield dividend stocks, you can diversify even further. You could have a mix of established companies, the blue-chip companies with a long history of dividend payments, and then maybe some faster-growing companies. That might have more potential for big gains.
So a blend of stability and growth potential.
It's all about finding the right balance for you. What's your risk tolerance? What are your goals?
Right.
And here's another really important point. Investing in these ultra-high-yield dividend stocks is a long-term game. Don't get caught up chasing those short-term gains or panic selling when the market gets a little shaky. Focus on building a portfolio of solid companies with sustainable dividends, and let those dividends compound over time.
That's the dream. So let's bring it back to the 5 companies we discussed earlier. Based on what we've just talked about, are there any specific takeaways for our listeners?
Yeah, definitely. Starting with Ares Capital. Their valuation is really attractive, and they've got good exposure to that growing private credit market. Those are definitely positives. But like with any BDC, it's important to understand how they manage risk and think about how those rising interest rates could affect them.
Right.
Now, Enbridge and Enterprise Products Partners, they've got those long dividend growth streaks and stable cash flows from that midstream sector. That's appealing for sure. But you have to think about the energy transition.
Yeah.
And the long-term demand for oil and gas.
Yeah, those are big questions.
They are.
Even for companies that seem as stable as those two, we need to be thinking about those long-term trends.
Absolutely.
Now that Honda Motor merger with Nissan, that's a really interesting one, especially with their potential to get bigger in the EV market.
Definitely.
But we need to keep an eye on how that merger plays out. It's not a sure thing.
It's a complex deal for sure.
And finally, with Pfizer, their commitment to those dividends is great.
Yeah, it is.
But can they really overcome that patent cliff? Can they actually generate sustainable growth from their new drugs?
That's the big question. They have a big pipeline of new drugs. But we need to look at the quality of that pipeline. Not just how many drugs they're developing, but how good they are and how likely they are to succeed.
Great point. Okay, so we've covered a lot, but there's one more really important thing we need to talk about. The potential risks that come with these ultra-high yield dividend stocks.
Right.
Because let's be real, no investment is perfect.
You're absolutely right. We can't just focus on the potential rewards. We got to talk about the potential downsides too. So in our final segment, we're going to be putting on our risk management hats and exploring those potential risks in more detail.
All right, everyone, welcome back to the deep dive. So we've talked about how awesome ultra-high-yield dividend stocks can be. We learned how to evaluate them like pros, and we even thought about some strategies for building a portfolio. But now it's time for the not-so-fun part. What are the risks? What are the potential downsides hiding behind those big, juicy payouts?
Well, you know what they say, no risk, no reward. And that's definitely true with these kinds of stocks. One of the biggest risks is that the company might cut the dividend.
Yeah, that's right. We talked about that a little bit earlier. It makes sense, though, right? If a company's earnings drop or their finances get shaky, they might have to reduce the dividend or even get rid of it altogether.
Exactly. And for investors who are relying on those dividends for income, that could be a big problem.
Yeah, it's not just about the lost income either. A dividend cut can actually cause the stock price to drop, too.
Exactly. Investors get spooked. They start selling off the stocks.
So it's a double whammy. Less income and a lower value for your investment.
Ouch, right.
Yeah.
Not good.
Yeah.
And those companies with the really, really high yields, they might be even more likely to cut their dividends, especially if they're not generating enough cash flow to support those payouts.
Right. It's like a house of cards. You need a solid foundation.
Exactly. And that brings us to another risk, interest rate sensitivity.
Okay. Yeah, we hear that term a lot.
Yeah. And it's especially important for dividend stocks, especially the ones with high yields. They tend to react a lot to changes in interest rates.
Really? How come?
Well, think of it like this. When interest rates go up, investors suddenly have more options. They can earn a decent return from safer investments, like bonds.
Oh, okay.
So those bonds start looking more appealing, and dividend stocks maybe not so much.
So the demand for those dividend-paying companies could drop.
Right, and that could lead to lower prices.
So it's all relative.
Exactly. It's about what looks more attractive at the time. And this is especially important right now because interest rates are going up. Investors need to think about how those rising rates might impact the companies they're interested in.
Okay, so we've got dividend cuts, and we've got interest rate sensitivity. Any other risks we should be aware of?
Well, there are also risks that are specific to each industry and company. Every company faces its own unique challenges. Like, take the energy sector. We talked about how the world is transitioning to renewable energy. That's a long-term risk for oil and gas companies.
Even those midstream companies like Enbridge and Enterprise Products Partners, I thought they were kind of insulated from the ups and downs of oil and gas prices.
Yeah, to some extent they are, but they're not completely immune to those long-term trends. Their pipelines and infrastructure will probably still be needed for quite a while. But eventually that energy transition could start to impact their growth. And down the road, It can even affect their ability to maintain those high dividends.
So we always need to be thinking about the future and how things might change.
Exactly.
Now, what about Pfizer? They're really reliant on just a few big drugs.
Yeah.
So they're pretty vulnerable to those patent expirations.
Yeah, once those patents expire, generic drugs can flood the market, and that can really hurt their profits.
That's the patent cliff we were talking about. Even if they have a ton of new drugs in development, there's no guarantee those new drugs will be as successful as their old ones.
Exactly. You have to look at the quality of their pipeline. It's not just about how many drugs they're working on. It's about how good those drugs are.
Yeah.
And how likely they are to actually make money.
Okay, so as we wrap up this deep dive into ultra-high-yield dividend stocks, what are the key takeaways here? What do we want our listeners to remember?
I think the main thing is this. These stocks can be a great addition to a portfolio, but they're not a get-rich-quick scheme. There are risks involved, just like with any investment.
Right. We got to be careful. Those high yields can be tempting, but we can't just chase yield blindly.
Absolutely. Don't ignore the fundamentals.
Right.
Do your research. Understand the business. Evaluate the risks. Make sure those dividends are built on a strong foundation.
And diversify. Don't put all your eggs in one basket.
Couldn't agree more. Now, I want to leave you with one final thought. Given everything we've discussed today, the potential rewards, the risks, what kind of investor do you think would benefit most from these stocks?
That's a good question. I'd say someone with a long-term mindset, someone who's comfortable with a little bit of risk, and maybe someone who's looking for regular income, someone who understands that the market goes up and down, and they're not going to panic when things get a little bumpy.
Yeah, you're totally right. Or maybe it's someone who's looking to spice up their portfolio a bit, add some variety. Go beyond just those typical growth stocks and bonds.
Right.
It really depends on the individual, their goals, their risk tolerance. But I encourage everyone listening to think about their own situation and how these ultra-high-yield dividend stocks might fit in. Or maybe they don't fit in.
That's such an important point. Investing isn't one size fits all. It's about finding what works best for you. And as always, we encourage everyone to do their own research, talk to a financial advisor if you need to, and make informed decisions.
Well said. Thanks for joining us on this deep dive, everyone. We hope you found it helpful and informative. Until next time, happy investing.
Happy investing.